Hello and welcome to our Credit Care YouTube channel. My name is Ian and I'm happy you've joined us today. Our mission is to help Canadians reach their credit goals. By sharing good credit information, we want you to know fixing your credit is within reach. Struggling with your credit can make you feel frustrated, helpless, anxious, or angry if you don't know what to do or have tried without results in the past. This often ends up with either ignoring your credit or just giving up. The good news is, no matter what your current credit situation, it can be fixed and you can have good credit. Through our videos, information, and creditcare.ca program, we will provide you with information, strategies, and ideas to help you form a plan for your credit success. Every trip starts with the first step. Congratulations as you are underway. Let's go. The topic of today's post is high interest loans, things to know. High interest loans are important to understand to determine if what you are getting is worth what the loan will cost you. We have received a number of inquiries about this topic recently, so I thought it would be timely to release a video on the subject, as there is some important information you should consider when taking out a high interest loan. In today's video, we will talk about credit cards, lines of credit, the cost of high interest loans, is the loan open, does the loan report to the credit bureau, and how Credit Care can help. We will start with credit cards. A lot of people don't think of credit cards as high interest loans. If you are using a credit card to purchase something and you're not going to pay it off immediately, in other words, prior to the interest being charged, this is exactly what a credit card becomes. Once you start paying interest of 20 to 30% on a carried over balance, this is how the deal you got on the purchase ends up costing you far more than you ever thought it could. As you end up paying interest on interest, especially if you make your minimum payment, your purchase can end up costing you 2 or 3 times the original purchase price. Credit cards, if used correctly, can help boost your credit score, but there are 2 important things to consider when you use them. Interest rate. If you carry a balance, you are going to be paying interest, and this can easily be as high as 29.95%. And the other is credit utilization. If you carry high balances on your credit cards, this will be reflected negatively in your credit score. Aim to keep your credit card balances at 30% of your limit, but certainly no higher than 50%. See our video, Your Credit Score Part 3, Credit Utilization, for more information on this topic. I often get a surprised look when I tell people a line of credit can become a high interest loan. Typically, lines of credit are at a low interest rate. So how do they end up becoming high interest? This happens to people in 2 ways. Number one, a person will buy something using a line of credit versus taking out a loan and then make either the minimum payment or a low payment that does not reduce the principal proportionally to the interest rate on the line of credit. Although this is a much lower interest rate than a credit card, the interest starts building in a similar fashion and results in an effective interest rate much higher than you started at. Number two, a balance carried from a purchase on a line of credit during a mortgage renewal will often be rolled into the new mortgage. Now the remaining principal is being financed over 10, 15, or even 20 years. There are times when a high interest loan cannot be avoided. Common situations can be a person who has had their credit damaged due to a divorce, illness, or job loss, and they need to buy a car to get to work. This is also common when a person is looking to buy something and they do not have established credit. This could be a young person or someone new to the country. If you have to take a high interest loan, here are some things to consider and information you should know in order to make building or rebuilding your credit as inexpensive as possible. Let's look at some of these now. Don't buy your dream car. We all like to drive nice vehicles, but when the interest rate is high, just don't buy your dream car. A $20,000 car paid over 60 months with poor credit, say 25% interest rate, will cost you over $15,000 in interest over those 5 years. The same car purchased with good credit, use an example of 5%, you would save over $12,500 during that 5-year loan. If you have to purchase a vehicle at a high interest rate, really think about what your goal is. And if it is to build your credit, spend as little as possible and get your dream car when the interest isn't a nightmare. There are 2 things that you should consider as must-haves if you're going to take a high interest loan. These are, number 1, is it an open loan? Make sure it is open. In other words, you can pay it off at any time without penalty and save the interest. And number 2, does the loan report to the credit bureau? Make sure any high interest loan you take reports to the credit bureau. Otherwise, you're spending all that money and not getting the benefit of your good credit behavior. This is certainly a must. It is important to pay off your high interest loans first. Some people make the mistake of paying off loans based on the remaining balance. This strategy can end up costing you more in the long run. If you have accounts with similar interest rates and any of your credit cards, make sure you get the balances under 50% of the credit limit. This will prevent the high balance from hurting your score. Once you have all your credit cards under 50%, then focus on getting them under 30% so your credit can benefit from the low balances. If you're looking to improve your credit score and you don't need a loan, creditcare.ca is a great way to build your credit and a savings account. This way, when you need to get a loan, you can qualify for better interest rates as you have established good, positive credit. If you've had to take a high interest loan, coupling it with a credit care program will speed up your credit rebuilding so you can qualify for a better interest rate faster. The key takeaways from today's video should be: number 1, if you can avoid a high interest rate loan, do so. This includes not using your credit card if you cannot afford to pay them off right away. Number 2, make sure if you use a line of credit, understand what payment you should be making so your principal is being paid down. Number 3, if you have to take out a high interest loan, make sure it reports to the credit bureau so you can use the loan to build your credit and position yourself to get better interest rates in the future. Number 4, make sure the loan is open so you can pay it off early and save those interest charges. Number 5, pay off your highest interest rate loans first and get your credit card balances under 50% of their limit. And number 6, creditcare.ca can help with programs and advice so you can reach your credit goals. Building or rebuilding your credit requires an understanding of how credit works. We have a lot of free information on our website that is there to help you understand how credit works. For those looking to build or rebuild their credit, creditcare.ca may be the perfect way to improve your credit and reach your credit goals. You don't have to be a Credit Care member to ask questions. Our goal is to help Canadians understand credit. Contact us and share your situation. We can help, and we will give you great credit advice. If you have any questions about today's video, or there's a topic you'd like us to cover, let us know by leaving a comment in this video, emailing us at help@creditcare.ca, or visit our website. If you found today's video helpful, we would really appreciate it if you would click the like button. If you would like to receive more credit information, click subscribe and the notification bell. Please share this video if you have a friend who could benefit from the information. Thank you. See you at our next video.